In my last video, I talked about how most mortgages in Canada are recourse loans, which means that if you default on your mortgage and the sale of your home doesn't cover the amount that you owe, then they can come after your other assets for the rest. And I had a couple of people comment that in my example, I used a 10% down payment, which means that it would be an insured mortgage, and they asked, wouldn't this person be protected by mortgage default insurance? And the short answer is no. And like I keep saying, the more you know, the worse it gets. So let's get into it. The key thing to understand here is that mortgage default insurance doesn't protect the borrower, it protects the lender. And don't take my word for it, you should look it up because it's important to know this. Basically, if you have a high ratio mortgage, it's a higher risk loan, and the bank doesn't want to lose money if you default on the mortgage. So the bank buys mortgage default insurance, which means that if you default on the mortgage but they can't recover all the money that they're owed from the sale of the house, then they can get the rest of the money from the insurer. The insurer also doesn't want to lose money, which is why insured mortgages are recourse loans. And that means you're still responsible for the loan even if the sale of the house doesn't cover the full amount. And again, you can verify all this for yourself. As an example, here's the CMHC's FAQ on mortgage loan insurance. Now, a lot of borrowers seem to think that they have mortgage default insurance that protects them. And the reason for this is that when they got the mortgage, they would have been charged a fee for mortgage insurance. And the reason for this is that banks don't want to lose money on the loan, so they get insurance, but they also don't want to pay for the insurance, so they pass those premiums on to you. And they do you the favor of just rolling those fees into your mortgage principal and charging you interest on them. So, the bank is protected by default insurance, and the insurer is protected by requiring that the bank makes it a recourse loan. The only way the insurer is really going to lose any money is if the borrower is forced to declare bankruptcy and they don't have enough unprotected assets to cover the balance on the loan. Now, there are a few types of assets that are protected in bankruptcy, most notably money that's in an RRSP and has been there for at least a year. If you have money set aside for retirement in a registered account or plan and it's been there for at least a year, it's not eligible money for creditors to go after. Of course, as you may know already, our government, in their infinite wisdom, has a plan that allows people to borrow money from their RRSP to pay for the down payment on a home. Like I said, the more you know, the worse it gets.